So we spend time to understand how do you identify a customer, right? How do you identify a customer contract? What are the important attributes is what we need from a customer contract perspective. How do you determine the duration of the customer contract? How important is the termination clause in the customer contract? Now we're going to talk about the next section, which is on identify the performance obligation, right, in a customer contract. So many a times this is fairly simple, so to say that if you enter into a contract with a customer for supply of goods, and that's the only item which is a subject matter of bargain, then it is fairly simple to say that this is the only performance obligation. Then what you need to determine is the quantity and the amount and the discounts, if any, and so on and so forth, right? But many a times, we experience that the customer contracts are not simple. Customer contracts have multiple elements, which are promised, or which are incorporated as part of any arrangement between the buyer and the seller. So when you look at a very simple example, right, let's say you go and buy any product out there in the marketplace. When you buy a product, there is a terms of services or a reference services, or you may receive a warranty document, etc. So in a way, there are two types of promises when you go and simply buy any product from the market. One is the product itself which you receive. The other one is the promise in terms of warranty obligations. And then the question comes is basically how many obligations I as a seller have are undertaking in this revenue contract, right? Or you as a buyer, you have a right to how many such benefits under the contract for which you paying a consideration, right? And remember, there's nothing called free. There's nothing which is called free in any commercial arrangement. There's nothing called free. Okay, everything which is being promised to a customer is being paid for, right? So if somebody is saying that I'm going to sell, let's say, if you buy 3 units from me, fourth is free, right? Now this fourth is not free. Actually, the price which is being charged for 3 also includes the price for the fourth unit, from that perspective. So nothing is free. I think that's the another important element is what we all need to keep that in perspective. So now we're going to focus on how do you kind of look at the performance obligation from a standard perspective. So when I think about a performance obligation, as I said, it's a promise in a contract to transfer to a customer either a distinct good or service. So I'm going to transfer a distinct good or service, or a series of distinct good or services that are substantially the same and have the same pattern of transfer. Now, when you look at a distinct good or service, when I mean, let's say you want to go and buy a mobile phone, right? That's a distinct good and service which you decided to purchase, right? Or you're getting a mobile phone repair, right? That's a repair as a service which you have. It's a distinct, in a way, service which you entered into an arrangement with the seller. Now, what is a series of distinct good or service, right? When we look at a series, the meaning of series is ordinarily we experience when you are doing for something like, let's say, a maintenance arrangement, right? So what happens in a maintenance contract, there's a promise which is being made, right? That I am stand ready to perform whenever you need. So every day, actually, I'm ready to perform. You need to demand performance from a maintenance contract perspective. So that's a series of performance obligations which I'm doing every day, or series of distinct good or services we also commonly experience in a lot of these time and material contracts, right? Which is, let's say, a telemarketing arrangement, right? When you have a telemarketing arrangement, from a customer, when you look at this arrangement, right, what is essentially you're doing? So you're saying that I'm going to make 1,000 calls or 10,000 calls or 100,000 calls, a million calls, on behalf of a customer to a range of targeted population, from that perspective. So that's a series of but every call is unique in its way, right? So that is why it's a series of distinct goods or services The question which comes here is that, do I need to look at these each of these component individually, or I can actually combine them and then account for them as one unit of account, because if I have to make a million calls and I have to account for them individually, it's going to be a Herculean task. So I'm going to look at the million call as a series of distinct goods or services that are substantially the same, that my performance obligation for making every call is substantially the same, and is the same pattern of transfer of my or fulfillment of my performance obligation under the arrangement, from that perspective. So you got to determine the performance obligation, right? So what are the performance obligation in the arrangement, and then you got to determine the performance obligation, and they ordinarily going to come from the contractual terms or customary business practices. So what all promises I am making under the contract is what I need to think through. And then many a times, as I said, we offer incentives. We offer incentives to our customer. Those incentives are also akin to performance obligations, right? Now, some of these incentives are very direct, to say that, if you buy this, you will get a discount of 20%. Now, that's the incentive which is related to that, and it is delivered together like a discount, not a separate performance obligation, so to say. But if you say that you are entitled for a discount if you were to purchase in future, right, then that in a way we have to evaluate whether that is a material right. And if that is a material right which I've offered to the customer, then that may become a separate performance obligation, right? Like or example is a free maintenance period provided by the automotive manufacturer. As I said, there's nothing called free. So if you buy a car, and along with the car you have a promise that 3 services are free, right? Now, if the 3 services are free, this is not warranty, this is services which is free. Now, then you need to identify that as a separate performance obligation, right? And then account for them appropriately. And we will talk about, in a way, all of that, from that perspective. It does not, in a way, include activities when you think about all these performance obligations, right? What we're saying, that does not include activities to satisfy an obligation, like setup activities. Now, this is also important. For example, you coming, you selling something to a good and saying that I'm going to come and set up. Now, unless that setup is considered as an installation, as a separate performance obligation, for example, then this is not a performance obligation, from the perspective of the standard. So you got to look at, as a customer, you have to always think it from a customer, that as a customer, am I going to benefit because of the promises you are making under the contract, right? Am I going to benefit on a standalone basis for each of the performance obligation? If the answer to that is yes, that's a separate performance obligation. Otherwise, it is not a separate performance obligation. It is a one combined performance obligation. And why this is important, that once you identify the performance obligation, then you allocate the transaction price. Once you then determine your contract consideration, that's the third step we will talk through. And once you identify or determine the contract consideration, then the contract consideration is required to be allocated to each of the performance obligations, okay? And then once you've done the allocation, then you do the recognition. So second step is very important for us to determine the performance obligation. What all promises I'm making under the contract, from that perspective. And that's a 2-step model. In a way, it's a 2-step model, which I need to look at, right? A 2-step model. And what is this 2-step model suggest? Step 1, it is capable of being distinct, and step 2 is distinct within the context of the contract. So the goods or services is capable of being distinct and distinct in the context of the contract. So if there are multiple promises being made in the contract, so they are capable of being distinct from one another, and we will try and understand this with the help of several examples. And they're also distinct within the context of the contract. So even though they are capable of being distinct, it is not necessary that I'm going to treat them as a separate performance obligation. If in the context of the contract, they are very, very important, and the customer is going to look at them as one unit of account, or look at them together, from that perspective. Customer may not benefit one versus the another, from that perspective. So we're going to look at it capable of being distinct within the context of the contract. That's a very, very important uh, definition, is what you should remember. So how do you identify performance obligations? Which is capable of being distinct within the context of the contract. If that been the case, then you got to identify them as a separate performance obligation. If they are not capable of being distinct, or they are not capable of being distinct within the context of the contract, then they are not to be identified as a separate performance obligation. Then they got to be combined and treat them together as one single performance obligation. And why this is absolutely important for us to do it right, because then this will actually drive the allocation of the contract consideration and the eventual recording and reporting of revenues as and when those performance obligations are fulfilled. And also, how do you actually record the revenue at a point in time or over a time? All of that is actually dependent upon identification of performance obligation in any contractual arrangement. So how do you look at this? With reference to contractual terms and condition, and also customary business practice. So capable of being distinct. So customer can benefit from the goods or services of its own. Customer can use goods or services with other readily available resources. And then you've got to evaluate. When we say capable of being distinct within the context of the contract, what we're trying to say here is that evaluate whether multiple goods or services work together to deliver a combined output. So whether multiple promised goods or services will work together to deliver a combined output, or they are not highly interdependent or integrated. If they are integrated, interdependent, then they are one unit of account. If they are not, then they are in a way capable of being distinct within the context of the contract. We will try and understand this with the help of few examples. So let's talk about a series of distinct goods or services. So if a good or service is a part of a series, and we talked about some of these maintenance arrangements or a time or material arrangements, we have an example on a hotel management arrangement, etc. So if a good or service is part of a series of distinct good or service that are substantially the same and have the same pattern of transfer, the series must be treated as one single performance obligation, right? Each distinct good or service in the series represent, like I talked about this, telemarketing arrangement where I have undertaken a contract to make 1 million calls. Now each call in a way is unique in its own way, but they have the same pattern of transfer. The series is one single performance obligation. From that perspective, the same method of progress in a way is used to measure the transfer of each distinct goods or service in the series to the customer. If that been the case, you're going to look at them as series of distinct goods or services. Now let's take this with the help of an example, right? With the help of an example. So entity enters into a contract to manufacture and install customized equipment. So there is a contract to manufacture and install customized equipment and provide maintenance services. So there is a contract to manufacture and do the installation, customized equipment, and also then provide maintenance services for a 5-year period. Now, installation services include the integration of multiple pieces of equipment. It includes the integration of multiple pieces of equipment at the customer facility in order for the equipment to operate as a single unit. So the integration is important, right? It's not a vanilla installation, so to say. So I have to do integration. Equipment cannot operate. So customer cannot benefit of the equipment without the installation. Entity do sell equipment and installation together. They does not sell installation separately. Other vendors can provide installation services. The maintenance, of course, is being sold separately. You wish to buy, you buy. You don't want to buy, don't buy. But if you want to buy this equipment, and then you have to necessarily buy the equipment and the installation. And for you to benefit from the equipment, it has to be installed, which actually requires a significant amount of integration which I need to do. So the question is that how many performance obligations I have under this arrangement, right? So when you look at the solution here, so how many performance obligations in a vanilla? If I think top of my head, right, I have equipment which I'm supplying, I have installation which I'm doing, and then I have maintenance, right? There are three things which I'm trying to do here, right? I'm doing equipment supply, I'm doing installation services, and I am doing maintenance. The question here is essentially for us is that do equipment and installation, are they two separate performance obligations, or they are one single performance obligation? And remember when I said, how do you identify whether they are two separate performance obligation or one? Is capable of being distinct and distinct within the context of the contract. So even though they are capable of being distinct, which is the equipment and the installation, but are they distinct in the context of the contract? And how do you identify this? Is this the customer? Can the customer can benefit from one without the another? Is it possible, right? And we had some fact patterns here to suggest that the customer cannot benefit, right, one without the another. And that's where the solution suggests that the two performance obligations, the equipment and the installation, because they are distinct within the context of the contract, and maintenance services because they are distinct services. So we're saying there are two performance obligation, the equipment and installation as one performance obligation, and maintenance services as another performance obligation. So there are two performance obligation is what I have here under the arrangement. How am I going to evaluate this? It is capable of being distinct. The equipment is capable of being distinct, but equipment and installation are highly interrelated. I need to do here integration. Installation, it is distinct, but again in the context of the contract, we have to treat them as one because one cannot operate without the another. The maintenance, of course, is a separate performance obligation because it is being sold separately. I as a customer may decide to buy. Even if I decide not to buy, I can still benefit out of the equipment and the installation services which I have already received from the seller. From that perspective, and that is why there are only two performance obligations in this arrangement, right? So let's look at another example, right? And this example talks about the construction services, right? So a construction services company enters into a contract with a customer to build a water purification plant. So there's a contract to construct a water purification plant. The company is responsible for all aspects of the plant, including the PA project management, engineering, design services, site preparation, physical construction of the plant, procurement of pumps and equipment for measuring and testing flow volumes and water quality, and the integration of all components, right? Now, the question here is whether the company has a single or multiple performance obligations under the contract, right? Now, what are we trying to say here? The question here essentially, when you see, whether project management, right? Is project management is a separate performance obligation, or for example site preparation, right? Or for example construction of the plant itself, right? And there are several activities, right? Construction. So are all they separate, or they have to be looked at together? And when you again think through this whole scenario, that you've been given a project to do a construction of a purification plant. The project is not to only do a design. The project is not to do site preparation, so on and so forth. So from a customer standpoint perspective, even though they are distinct activities, but they are not capable of being distinct in the context of the contract. And hence the answer here is that it is one single performance obligation. So represent a performance obligation on its own or required to be aggregated. In order to determine how many performance obligation, the company applies the guidance, and what is the promised goods and are subject to significant integration, and as a result will be treated as a single performance obligation. Yeah, I'm going to just kind of pause here for a second, and then you please read this slide, and then we'll move to the next slide, right? Okay. So continue to move forward. So again, as I said, this is consistent with the view that the customer is primarily interested in acquiring a single asset, which is a water purification plant, rather than a collection of related components and services. And hence, it's one single performance obligation. is not a multiple performance obligation in this arrangement. All right, let's look at another example, right? This example in a way suggests that the entity provide broadband services to its customer along with voice calls. So I'm doing broadband and I'm also providing calling, right? Now the customer buys the modem from the entity. However, the customer can also get the connection from the entity and modem from any other vendor, right? It is like any arrangement where a telecom service provider, you say, okay, I'm selling the equipment, which is the modem which is required. You want to buy it, you can buy it, else you can buy it from the market also. And along with that, I'm selling broadband. You can buy broadband services, or you don't want to buy broadband, you can buy voice services. So there are multiple things which I'm selling here, and you're free to choose what you want to buy, and they're not interdependent. Of course, you need the modem to provide the broadband services, but you can also decide to buy it. If you bring in a third party equipment, I can still provide you a broadband service or a voice calling service, etc., etc. The installation activity here requires limited effort, is largely plug and play, and the cost is also insignificant. It has various plans which provide other broadband services with voice call services or both, so multiple plans they have. Are the performance obligation under the contract distinct? Do we have a distinct performance obligation? So what are the things actually we are talking here, right? We are talking about broadband service, right? And we are talking about voice calling, right? And we are talking about we're talking about modem, right? So if you look at all of these are the three distinct so to say services which I see being promised in this contract. The question is, are capable of being distinct? Yes, and distinct within the context of the contract. So I, as a customer, I want to benefit from each of its own. Yes, I can buy a modem, then I can decide to take a connection from telecom service provider A or B or C, whichever is out there. Then I may decide to buy the modem from the service provider itself, and then say, give me broadband or give me voice. There are multiple plans out there. So when I look at this in totality, right, what do I get? Broadband, voice, modem, entity promises to provide goods and services distinct, right? If the customer can benefit from the goods or services either on its own or together with other resources that are readily available to the customer. Entity promises to transfer the goods or services to the customer is separately identifiable, right? It's identifiable. So when you look at again for the broadband and the voice, these are again being promised. These are separately identifiable. They are separate plans, all of that, and they are not interdependent or interrelated. Similarly, for the sale of modem, you can decide to buy from the service provider. You can buy it from the market. There are no customization, no integration is required. So it seems that there are three different services which are being offered, right? In this example, there are three different services which are being offered in this example. Now let's quickly look at a series of distinct goods or services, right? We talked about few in that sense, but again, could the series requirement apply to a hotel management, right? So let's say I've undertaken a project to do hotel management on behalf of a hotel owner, and when I am doing a hotel management, I'm doing multiple things, right? I'm providing the reservation, I'm doing the guest maintenance, and I'm doing I'm also looking at maintaining, let's say, the cafeterias and restaurants and so on and so forth, procurement, accounting, many things which I'm trying to do here, right? Now, are they multiple services, or they're all interrelated, right? In a way. So when you look at again, though they are distinct, but they are substantially the same. They come under the same umbrella. From this perspective. So and hence the underlying activities, for example, the reservation services, the property maintenance services, are activities to fulfill the hotel management services rather than separate promises. The distinct service within the series is each time increment of performing the service. So you won't treat them as separate performance obligations. These are series of performance obligations which are then looked together as one performance obligation from a revenue recognition perspective. And then, of course, we will talk through that how do you actually get to the recognition, right? So this is first identification stage, and then, for what type of service or what type of goods, how do you record revenue, from that perspective, is what we're going to look at, from that perspective. So let's look at multiple element arrangement that are not distinct, right? So once an entity determines whether the goods and services would be distinct based on their individual characteristics, the entity then has to consider if the manner in which the goods and services have been bundled in an arrangement, whether that would require the account for them from a two or more, in a way, performance obligation, in that sense perspective. So you again, what I'm trying to say is that you have to look through the contract very, very carefully, right? You've got to look through the arrangement very, very carefully to say what all I am promising as part of my commitment to this customer. Whatever you are going to promise to your customer is what you need to identify, and then you need to evaluate. So are they capable of being distinct within the context of the contract? I, as a customer, can benefit from each of them independently if I were to combine them with other resources which are available to me. How do market forces perceive some of these services which I am promising under the contract? Are they one performance obligation or they are multiple performance obligation? This distinction is important for us to examine and conclude. This is an area which also, of course, do involve some judgment, right? It involves some judgment as well. So that's where you got to apply yourself better. It's a complex area of accounting many times, but from your examination perspective, I would expect that the questions will be simple in a way where you should be able to identify that how many performance obligations do have in this arrangement, right? And we're going to talk through a lot more examples and lot more scenarios in a way for your benefit. Okay, so let's look at this example, right? In this example, entity A is a construction firm, enters into a contract with entity B to design and construct a multi-level shopping center with a customer car parking facility located in sub-levels underneath the shopping center, right? Now, the entity B solicited bids from multiple firms on both phases of the project, design and construction, right? So you're soliciting bids for both phases, design and construction. You're not asking separate bids, right? It's a separate bid for design or separate bid for construction. You're asking for both. Give me your, in a way, quotations or your submission of acceptance of this requirement. So now, when you look at this, the design and construction of the shopping center and the parking facility involve multiple goods and services, from architectural consultation, engineering through procurement, installation of all the materials. So the whole question is that how many performance obligation do I have here? Do I have multiple performance obligations, which is the design is a separate performance obligation and construction is a separate performance obligation? So again, when you look through, the question suggests entity A may require to continually alter the design of the shopping center and parking facility during construction, as well as continually assess the propriety of the materials initially selected for the project in a way. So what this essentially suggesting, right, that the design and construction are closely interrelated, right? The one cannot stand without the another. I, as a customer, may not benefit only with the design without actually having the end game, right? Without having the product in place, which is being promised through the design. And such is the nature of this promise, the design may need to continuously change to accommodate in a way the requirement, from the perspective of the end output, right? And that is where, when you look at this, the analysis of this, that there is a continuous change, alteration in the design of the shopping center and the parking facility. Therefore, the design and construction phases, right? The design and construction phases are highly dependent on one another. So, if they're highly dependent upon one another, then what do entity A will end up concluding? Entity A then will end up concluding that the design and construction services will be bundled and accounted for as one performance obligation. They are not here two performance obligations. It is one performance obligation because they are highly correlated. They are highly dependent. As a customer, I need both of them to function and work. Otherwise, I won't benefit one from the another, from that perspective. Let's look at another example, right? Now, an entity, a software developer, enters into a contract with a customer to transfer a software license, performs an installation service, and provide specified software updates and technical support, installation, and also license for a 2-year period. The entity sells the license, installation, and technical support separately as well. The installation service includes changing the web screen for each type of user. The installation service is routinely performed by other entities and does not significantly modify the software. The software remains functional without the update and the technical support as well. The question is, how many performance obligation does the entity have? How many we have? Now, if you think through this example, right? What am I doing here? I am selling the software license, right? And then I am doing the installation. And then I am doing the specified updates, right? I'm giving you that these many updates you will receive, right, in a 2-year period. And then I'm also doing technical support. Right. Now, when you look at all of these, there are 4 things which I have promised to this customer. 1, 2, 3, 4. 4 different things, right? And then again, when you look at the fact pattern, are they dependent upon each other? The answer to that is no. They are not dependent upon each other, right? Now, if I purchase this license, can I continue to operate this license? Answer to that is yes. They are functional. Can I get this installation done by anybody else? Yes, you can do it, get it done by anybody else. Does this require significant modification? No. There is no modification in a way required which will alter the product itself, right? And then there are specified upgrades, then there are technical support. Now, many in some of the example, actually, when we see in real life, we don't see specified updates. Okay, we see unspecified updates. Now, if there are unspecified updates, from a standard perspective, actually unspecified updates are part of then maintenance. Unspecified updates are not considered as a separate performance obligation. They are a performance obligation, but they are part of maintenance, right? That becomes part of, combined with the maintenance. That's where, in a way, you look at them as a separate. But here it is specified updates, right? Now, so when I look at the solution in a way suggests that there are 4 performance obligation here, right? Which is the license, which is the installation, which is the update, and which is the technical support. So entity has to assess the goods and services promised to the customer to determine which goods and services are distinct, capable of being distinct within the context of the contract. Remember, right? I, as a customer, can benefit from each of them without being dependent on the other component, right? And or I can benefit in a way by in a way leveraging with the other things which I already have, right? So entity concludes that the customer can benefit from each of the goods and services either on their own or together with the other goods and services that are readily available. And that's why is saying there are four performance obligations, four different types of performance obligations here, right? Four performance obligations, okay, which is the software license, which is the installation services, which is the specified upgrade, and the maintenance. Now, remember I said if it had this been unspecified upgrade, okay, then I would have said there are only three performance obligation, which is the license, the installation, and the maintenance, which is the technical support. Then because then the unspecified upgrade is not considered as a separate performance obligation. What happens is that unspecified upgrades then come as when and if available, right? So if it is not available, I will not provide, right? That means there's no, this is only, during the maintenance. If I have it, I will provide, like what Apple does, right? If they're selling you a product, they're buying an iPhone, they are not promising that you will receive an update, this update next year, right, with these features, right? They're saying if there is an upgrade available, you will be provided with that upgrade, provided there is a compatibility with your hardware, which ordinarily, let's say they promise that if you buy a hardware, for the series, it ordinarily should be valid for next 5 years, from that perspective. So you got to look at the arrangement and then evaluate what is it I am actually getting as part of the contract for you to determine that how many performance obligations do I have. Now let's think about and talk about the options which are granting material rights, right? And that's important. In many examples we see that, and many of the companies do run some of these promotion schemes, right? That if you were to buy goods worth 2,000 rupees now, you are entitled for a discount of 500 rupees, right? For a sale, which for a purchase which you may do in the, let's say, in the month of January. If you spend 2,000 rupees with me in the Diwali festival season, or let's say in the month of October, you will get a coupon of 500 rupees, and that coupon in a way entitles you to a discount of 500 rupees in the month of January. The question here is, does the contract grant the customer the option to acquire additional goods or services? Yes, I have an option to acquire additional goods and services. Does the option provide a material right to the customer that it would not receive without entering into the contract? If the answer to that is no, then it is not a separate performance obligation. If the answer to that is yes, then it is a separate performance obligation. So will I receive a discount of 500? So if I going to walk into that store in the month of January, will I receive a discount of 500? For example, right? If I don't enter into this contract today, the answer to that is, in a way, no. So to say that I won't get any benefit, in a way, then there is a right, which is I'm going to benefit, right? And hence it's a separate performance obligation from that perspective. So we'll try and understand this with the help of an example as well, right? So in this situation, revenue is recognized when future goods and services are transferred or when the option expires. So you got to again evaluate the fair value of the option. The option itself becomes a separate performance obligation, right? The transaction price is allocated to performance obligation based on relative standalone selling prices, and we will talk a lot more on how do you look at the methods of allocation. If the discounted price in the option reflect the standalone selling price, the entity is deemed to have made a marketing offer rather than having granted a material right. If it actually reflect the if the discount is available to anyone and everyone, then it is not a material right, from that perspective. So we're going to try and understand this in a way with the help of an example, right, where it may be easy for you to understand this concept. Let's look at this example. So an entity enters into a contract for the sale of product A for INR 1,000, right? As part of the contract, the entity gives the customer a 40% discount voucher for any future purchase up to INR 1,000 in next 30 days. If you were to buy in next 30 days, you will get a 40% discount. the entity intends to offer a 10% discount on all sales during the next 30 days as part of a seasonal promotion, right? The 10% discount cannot be used in addition to the 40% discount voucher. That means that the 10% is actually subsumed into the 40%, right? So the entity believes that there is 80% likelihood that the customer will redeem the voucher, and on an average, a customer will purchase INR 500 of additional products, right? Based on this fact pattern, you have to determine how many performance obligation does the entity have and their standalone selling price and allocated transaction price. Now think about this. So what is I'm doing? I'm selling a product A. Okay. What is it I'm doing along with this product A, which you are buying, right? I'm saying I'm going to give you a 40% discount voucher. Now, for any future purchase up to 1,000 rupees, right? So in future, you're going to buy 1,000 rupees worth of goods. That means you have to only pay 600. However, I'm anyway going to run a 10% promotional discount for anyone and everyone who's going to buy 1,000 rupees worth of goods from me in next 30 days. So whether I enter into this contract or no, this 10% anyway is available to me, right? So now for me to get into this contract, what is the incremental benefit I am getting is 30%, right? The incremental benefit or the discount which I'm going to get because I'm entering into a contract today is 30%. Now, how many customer I expect or believe that will go for this scheme, right? Is I believe that there is 80% likelihood, there's an 80% likelihood that those who buy 1,000 rupees worth of goods today, 80% likelihood that they will go and buy, avail this discount for up to how much amount? 500 rupees. So there are multiple estimates, assumptions are provided as part of the fact pattern. The question to you is, how many performance obligations do we have, and how do I allocate, how do I determine the standalone selling price, and what is my allocated transaction price? So how many performance obligations I have? When I look at this, I have here 2 performance obligations, right? What are those 2 performance obligations? Everybody is going to receive discount of 10%. That's not a material right? Now, I'm going to give additional 30% discount. That's the material right to a customer. So essentially, the entity promised to provide the incremental discount is a separate performance obligation in the contract for the sale of product A is one performance obligation and the material right, which is the discount voucher. That's the another performance obligation. All right. Now, entity believe there's 80% likelihood, right? So, and what is the amount they like customers like to purchase? This is 500 rupees, and then there's a 30% discount, right? So you got to value the value. You got to determine the value of the material right. So in a way, the value of the material right is nothing but 500 right into 30% into 80%, which is 120, right? 530 is 150 into 80 is 120, right? So that is what the value of the material, right? The standalone selling of the product A is 1,000. The standalone selling price of the material right is 120, right? Now I need to determine how much now I need to allocate. So if you see, there are why this whole steps in this example we're trying to, so there was identify the contract. I've identified the contract with the customer, right? I've determined what are my rights and obligations. Then I've determined how many performance obligation I have. I said I have 2 performance obligations, which is the sale of product A, and also I have sold a material right to this customer, right? Now then I said, what is the total contract consideration? I am only receiving 1,000. I'm not receiving more than 1,000, right? I am receiving 1,000. So total contract consideration is 1,000. right? Now, how do I allocate 1,000? So that's my third step. Determine the total contract consideration, which is 1,000, right? Now, I need to allocate this 1,000 to each of the performance obligation, right? What are my performance obligation? Two performance obligations. So let's look at this, right? So the standalone selling price here is product A is 1,000 and here is 120. So total, if I would have, if I would have sold them individually, I would have possibly charged 1,120, right? But how much I have received? I have only received 1,000. So what is the, and I've already fulfilled my performance obligation by selling product A. The option is yet to be exercised, so yet to be fulfilled to the customer. So I can't record revenue for the option piece, right? Because that is, I haven't yet fulfilled my performance obligation. So I then need to do, this is what is called relative standalone price. Relative standalone price. Okay. And we will talk about this more, right, when we look at the step 4, that how do you allocate the transaction price to each of the performance obligation. Here the entity will allocate, which is 1,000 divided by 1120, because 1,000 was my contract consideration. 1,000 divided by 1120 into 1,000, 890 goes to product A and 110 goes to the material, right? So 1,000 is your total. That means if let's say you're on 31st of March and you have sold the product, how much revenue you will get is only 890. Even though you may have already received 1,000 rupees in your bank account, you won't get revenue as 1,000 rupees. You only get revenue as 890. Why? Because you have also sold a material right to a customer, right, for which you have yet to fulfill your performance obligations. Okay. So the discount voucher is considered as a separate performance obligation, because this discount voucher is not available to anyone and everyone. This discount voucher is only available to you because you have entered into this contract with me, from that perspective. All right. So let's try and summarize in a way what we have talked about, right? So if you made promises in a contract with the customer, you got to identify all promises, explicit or implicit. Then how do you identify? You have to look at a distinct goods or services capable of being distinct, and then distinct within the context of the contract. If there are options granting material right, you got to identify them, and then you got to evaluate them, and then appropriately account for them. And if there are goods or services that like series of distinct goods or services, in a way you kind of providing, in a way, even though they're distinct, you got to look at them as one combined performance obligation. And even though they are distinct, but they are not distinct within the context of this contract, then you're going to account for them as one performance obligation. So in the series guidance or otherwise, when you are not supposed to separate them, you're going to account for them as one performance obligation. So now we have talked about the 2 steps in revenue recognition, which is identify the contract with the customer. Then I need to understand, is this customer contract is enforceable under a court of law? If it is yes, it can be in oral, it can be in writing, it can be in any form, provided it's enforceable. It has to articulate all the terms and condition. It has to say what's my contract consideration, how this contract consideration will be settled, etc. All of that is being done. Then you figure out what are my performance obligation. Then how many performance obligations do I have? Do I have 1, 2, 3, 4, 5, depending upon what all promises you have made. Nothing is free. There's nothing called which is free. Okay. So you got to identify all your performance obligation under the contract, right? So, and when you identify that, you need to then assess whether you need to treat them separately or when you need to treat them as one single performance obligation. And that you do based on assessment that are they capable of being distinct? Are they distinct within the context of the contract? If the answer to that is yes, then you're going to look at them separately. And then we're going to talk about determination of the transaction price and then allocation of the transaction price to each of the performance obligation. And then may have many other nuances which we're going to try and cover. But I think important thing is we got to identify all my performance obligation, and that is principally going to come from your contractual terms and your customary business practices, right? All of this is what we need to understand. Okay, moving forward. Now we're going to talk about principal and agent. So am I a principal in the arrangement or am I an agent in the arrangement? That's what I'm going to now talk to you guys about. All right. Okay, I'm going to take a pause here. Thank you.